What's up, guys? It's Rob here, and we have to talk about support.com, ticker symbol SPRT, because this stock is dumping today, and we need to get to the bottom of it and what might be going on with some very scary news regarding this stock that could be taking place in just under 2 weeks. So let's take a look at the stock, and we have the chart right here. We can see that we are down over 7.5% today. We're down around $20, and we actually just hit this $20 psychological support level. We can see right here. If we just zoom out a little bit, we can see the $20, although it hasn't technically acted as a support or resistance in the past, is a strong psychological support for any stock, right? 10, 20, 30, 40, those are all strong psychological levels, and that is why we have bounced off of it right here. We can see we got very close, and now it looks like we're actually on our way down a little bit more. So we're probably, in my opinion, going to be breaking through this today unless some really strong buying pressure comes in. And, that's to be expected, because what we can see here is that we had a very strong rally from $5.81 to $59.69, and have since then been trading down and sinking lower and lower and lower. And just 20 is the next, feather in the cap of the short sellers. They're hoping to break through 20 and just get us lower and lower and lower. So what's very scary that I've noticed about SPRT, well, first I'll delve into this. You can see their search history on Google. You can see we were actually making decent numbers, right? We were going higher and slowly sinking. But what we see here after the long Labor Day weekend is the search volume is actually fairly lower than it was before. We did have a little blip over Labor Day weekend. However, we are now sitting around a ranking of 50, and this basically relates back to how often it's been searched in the past. So we can see that interest in SPRT is declining, and this could be very bad for the stock, because what this stock really needs is more interest, right? Because the short interest is at 61%, which could lead to a short squeeze, right? That is a very high percent of short floated. Now, it would take a rather large movement in this stock to actually get those shorts to need to cover their position, because you can look and you can see that the short interest is only 6.18 million shares. Now, although that's a high percentage of the float, when you look at the number of shares and you multiply that by the stock price, 6 million times $20, that's about $120 million worth of short positions out there. And that means that institutions, if they're split between 10 institutions, only have about $12 million worth of short position each. So for this to actually become a viable short squeeze, that number would have to get much higher, and those institutions would have to be a lot more worried, and the brokerages that support those institutions would have to start margin calling them, and that's unlikely to happen unless this stock really shoots up in a massive way and turns that number into one that's much larger, right? The institutions basically need to have a lot more money on the line regarding their short positions here before that short squeeze actually takes effect and causes some margin calls. So what we have right here actually is a very scary statistic. If you look at the options open interest activity, you can see September 10th, there's nothing too crazy here. Not many options are being traded. But if you look at September 17th, it's not the calls, and it's normally the calls that I talk about, because those can cause gamma squeezes. And you can see there are some open interest calls, right? 4,000 for $20. $30 has 17,000. But all in all, it's not that impressive, right? We don't see that many open interest call options. However, when you look at put contracts, open interest put contracts for September 17th, you actually start to see something very scary. And the reason this is so scary is because there are a massive number of open interest put contracts. And this could actually be giving the shorts a way out without having to without having to buy back the shares, really, right? If you look at this, you see the percent of float short is 61%, and that seems like a massive percentage. However, then you look at the short interest, it's only 6.18 million. Now that means 6.18 million shares are short. And what this means right here, the open interest put options, you can see actually add up to quite a bit, especially as you start getting into the lower valuations. $12 has 10,000 open interest put contracts. $11 has 12,000 put contracts. 24,000 put contracts for $10 and 28,000 for 7.5. Now, what this means is that it's likely that institutions are selling these put contracts. And what could be very bad for investors who are hoping for a short squeeze, because they see that very high short float percent, is that if this stock actually ends up dipping and we get below $10, let's say, or $7.5 by September 17th, and these contracts actually execute, then that would drastically lower the short percent float. Now, why that is because when an institution sells a put contract like this, they are offering to buy the stock for a certain price. And if this contract actually gets executed, that means they're forced to buy it for that price. And you would think that that would be very bad for them, especially if the stock has dipped far below this price. Now, where that doesn't necessarily take effect is if they've already shorted the stock. They already have sold a share. Now they just have to buy back their share for probably a lower price than what they paid for it, especially if it's these low priced options contracts, $12, $7.5, $10. If they're buying back the shares at those prices, they've probably been shorting them, around here, 50, 60, 40, $30. They're actually going to be making quite a bit of money if those options contracts execute. And that is something that investors really have to watch out for, because this potentially gives the institutions an easy way out. If you actually do the math, let's take a look at the number of contracts there are available. Let's just say, 4,000, 5,000, 6, 7, 8, 18, 23, let's say like 30 or 40,000. Let's say this thing doesn't even get to $10. It just gets to $11 right here. That's at least 40,000 open interest contracts. And that actually equates to, I believe, 4 million shares. Because you have to multiply that number by 100, because each options contract equates to 100 shares of stock. So that's actually about 4 million shares right there, which almost, more than 50% of the short interest would be wiped out with that alone. And it didn't even get to $10 yet. So that last remaining 2 million shares would actually be wiped out if we got below $10. So that's something that a lot of investors should really pay attention to and potentially be worried about institutions sneaking out of this short position through options contracts. So that's something you have to watch out for. And that's what I have for you guys today. So if you've enjoyed this video, then feel free to like the video and subscribe to the channel. I would greatly appreciate it, but no pressure to do that if you don't want to. Other than that, have a great day, guys, and trade carefully. I'll see you in the next one. Bye.